Welcome back to the show. U.S. has outperformed the rest of the entire world, but now there's a wobble in technology, which makes up a big part of our market on these higher rates. Is it time to go elsewhere?
Not really. If you look at where the damage is, you'll see that it's mostly in those companies that are not making money. Companies like GameStop, Open Door, Rocket Lab, companies like that are not earning, and they're really getting hit down 11, 12%. But then if you look at Alphabet, if you look at Amazon, they're at best moving sideways, maybe down a little bit, but not much. So what we're going to do is focus on in emerging markets, those companies that have good cash flow, good margins, and they're still going to continue to do well. You know, there still is a semiconductor shortage, so we're really going to stick to those and maybe add to those.
Is there a particular market, a country that is appealing there, or you're going company and sector specific?
Well, the two countries are Taiwan and India. Taiwan is going like gangbusters because, as you know, TSMC is located there, but all of the companies that support the semiconductor industry, the fabless companies, are doing very, very well. So that's big for us. And India, I mean, the strange thing is that you see China going down since February about, 32%, whereas India is up something like 17, 18%. So we've got to really differentiate where we're looking and what countries we're going to be in. But India and Taiwan are at the top of the list.
I want to make sure, Mr. Mobius, that I heard you correctly in your first answer to Sarah. This is Scott. It's nice to see you.
Hi, Scott.
Did you say that you still think that the U.S. is the best place to invest? I think when Sarah asked you, would you go elsewhere, you said no.
Oh, no, we will go into emerging markets, no question about that. But the U.S., of course, is the biggest market, and you have the great companies. But what I've been trying to tell people is that a lot of these companies, let's say Apple, look at their overseas earnings, look at their emerging market earnings, and look at where their products are being made. It's emerging markets. So emerging markets still are going to garner a lot of that earnings capacity that the U.S. companies are generating. So yes, U.S. market, you've got to be in there, but you should really be looking at emerging markets because they benefit from what's happening in the U.S.
What happens ultimately? Let's say the taper moves faster than expected. Interest rate hikes are pulled forward quicker than we think. Won't that have a negative impact on the emerging markets?
It will have a negative impact everywhere. It's generally feeling that once interest rates rise, you've got a problem. But the good news is those companies that are in a very strong earnings position with good margins, even in a higher interest rate environment, will do well. So this is something, if you look at the history of earnings and the history of markets, you'll see higher interest rates don't necessarily mean a big downturn in the markets.